Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing GoPro stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a micro cap company, 213 million market cap. They're trading at $140 a share, and they have 152 million shares outstanding. GoPro develops and sells cameras, mountable and wearable accessories, as well as subscription services. They sell all over the world, US, Middle East, Asia, Africa, etc. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Pretty good free cash flow in 2021, 224 million. That was with 1.2 billion of revenue. Revenue went down to 1.1 billion. Their cash flow was pretty much break even. Then they fell to 1 billion, then under 1 billion. It appears they need to be north of 1 billion of revenue to be profitable. Net income is the profit or loss on the income statement. It's revenue minus expenses. Same trend, positive in 21 and 22, negative in 23 in the trailing 12 months. Revenue is a sales for the company, and that goes down each year from 1.2 billion to 1 billion. A really attractive price to sales ratio. Price to sales is stock price over sales per share. It's 140 over 648. Usually a price to sales of 1 is good. They're well below a 1. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 718 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of negative $630 million. We divide that by 150 million shares. And we get a calculated stock price of 0. They're trading at 140, so it's a sell according to the model. Pretty much every scenario, they go bankrupt. It doesn't really seem like they can dig themselves out of this hole. That doesn't mean you can't make money in the stock. The stock will move up and down until it goes to 0, assuming it does go to 0. You can make a ton of money on a stock like this and lose a ton of money on a stock like Apple if you time this well and time Apple poorly. But if you hold this in the long term, you'll lose money. With a company like Apple, you'll make money in the long term. But in the short term, you never know what could happen. There are 19 companies in the same industry as GoPro, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the same as the median in CapEx, only 2 million. It's a really low median. A lot of these companies are 0. Debt to equity ratio is worse than the median average. When we look at their balance sheet later, we need to see how much debt they have and look at their cash burn to see how many quarters they can survive. Because somebody mentioned in a comment that they're trading below cash value, which means their market cap is lower than their cash. But if their cash burn is really high each quarter, it doesn't mean much. Negative free cash flow, they rank 7th in market cap, which is higher than the median because there's so many small companies on this list. Their price to book is below 1, which means they're worth more in bankruptcy than as an operating entity. We cannot look at their PE or price to free cash flow, a really attractive price to sales. Almost 1 billion of revenue, much higher than their market cap. But they're not growing anymore and the market looks towards the future. Their 5-year annual revenue growth rate is negative 4%. Sometimes it doesn't really matter what their market cap is. If they have negative revenue, their market cap will keep going down. They may have to do some reverse stock splits to stay on a major stock exchange. But in the long term, their market cap will likely go down. If you were crazy enough to put 10K in this company 10 years ago, after a few months you were really happy, up about 70%. But if you're still holding on, you would have lost 97% of your investment. That $10,000 would have been $331. Let's look at their income statement. First quarter of 23, first quarter of 2024. Revenue is down 175 million to 155 million. Let's see if they give a breakdown of the revenue so we know what it is. Of the 155 million of revenue, 106 million is retail. Those are the retail sales of their cameras, 68% of their revenue. They have services through GoPro.com. That was 49 million, 32% of their revenue. GoPro is going down a lot. It was 95 million last year, now it's only 49 million. But surprisingly, retail sales is up from 80 million to 106 million. Revenue in the Americas is down from 90 million to 76 million. It's half their revenue. EMEA is up 46 million to 52 million. APAC is down as well, 39 million to 27 million. Let's see what they say about the revenue declines. When you compare 1Q 2024 to 1Q 2023, revenue is down 11%. 15% decrease in units shipped. They shipped 390,000 cameras, last year 460,000. That's offset by a 12% increase in subscriptions. The decrease in units shipped was from a softer consumer market within the Americas and APAC, particularly in China. 70% of their cameras sold for $400 or more. Last year, 87% sold for that price. But the average selling price per camera increased 4.5%. GoPro.com revenue includes subscription and service revenue, $49 million, which was a big drop from last year, because last year was $95 million. Right here it says a 12% increase in subscription and service revenue. I don't understand how they can have an increase in subscription and service revenue when it went down from 95 million to 49 million. Maybe they're charging 12% more than last year, but they have less customers. It's a little confusing. Okay, here's their income statement. Cost of revenue is 102 million. These are all the expenses directly tied to generating the revenue, like the cost to make their cameras, which includes the materials, payroll, the light bill in the factory. So their cost of revenue is going up. Last year was 30% of their revenue, now it's 34%. Revenue minus cost of revenue gives you your gross profit, 53 million. Margins are going up. It was 30%, now it's 34%. Gross profit margin is gross profit over revenue. It's a percent of your revenue you convert to gross profit. Even though their revenue went down, their cost of revenue went down even more. So they actually have higher gross profit with lower revenue. That's a really good thing. But you can't cut expenses below zero, and if your revenue keeps going down, eventually your gross profit will as well. Here they talk about their gross margin. The improvement was due to lower camera costs, lower by 230 bips, 2.3%, a 1.1% increase in subscription and service revenue, and lower operational costs. Below gross profit is operating expenses. The biggest one is R&D, research and development, 45 million, 29% of their revenue. Last year was 22%. They give a nice breakdown of R&D. Most of R&D is payroll. They also pay stock-based compensation, 4.2 million, and other costs as well. The increase was driven by 3.1 million in cash-based personnel costs. That's payroll or bonuses. A $2.3 million increase in consulting and professional services, a $1 million increase in restructuring charges. Restructuring charges are one-time expenses a company pays to reorganize their operations. It could be from laying off employees, closing a factory. They did lower their SBC $500,000. You can see that right here. It was 4.7 million, now it's 4.2 million. Below that is sales and marketing, 35 million. That's down from 38 million, but up as a percent of their revenue. Sales and marketing went down, so did SBC, but restructuring went up. It was only 6 million, now it's 550 million, a 9,000% increase. The decrease in this category was driven by a $1.7 million decrease in credit card fees. So every time a customer pays, this company has to pay about 2 or 3% to the credit card company. A decrease of 1.6 million in advertising. That's partially offset by a $400,000 increase in cash-based personnel costs. That's employee salary or bonuses. G&A is 15 million, down from 16 million. I like they give so much detail. I wish all companies did this. Here's G&A, SBC is down, restructuring is up a lot, acquisition cost is up a lot. The decrease was driven by a $1 million decrease in consulting and professional services, partially offset by a $700,000 increase in acquisition-related costs. Operating expenses 95 million, gross profit 53 million. So their expenses are a lot higher than their gross profit, which means they have an operating loss of 41 million. Last year, 40 million. Interest expense of 700,000. This is the interest they pay in their debt. 1.2 million of other income. Here they talk about interest expense and other income. So total other income is 500,000. That's a sum of interest expense and other income. So it decreased from 1.7 million to 500,000. It decreased by 1.2 million. The $1.2 million decrease was from a $900,000 decrease in interest income. That's the interest they receive on their cash, and an $800,000 decrease in net foreign exchange rate based gains. Partially offset by a $500,000 decrease in interest expense. That's the interest they pay in their debt. as they got rid of their 2025 notes. Their loss before taxes, $41 million, taxes of $300 million. It's a lot of taxes, especially since they have a pre-tax loss. So a net loss of negative $339 million. Last year was a net loss of $30 million. They talk about it right here. We recorded an income tax expense of $300 million. This is from discrete items that included $295 million of net tax expense from a valuation allowance on a deferred tax asset. A deferred tax asset is carried on your balance sheet and passed through onto the income statement. So it looks like this deferred tax asset was sitting on their balance sheet probably for a while. So it looks like they had to finally remove the asset off their balance sheet and pass it through onto their income statement. They talk about it in a lot more detail here. We assess positive and negative evidence to estimate whether sufficient future taxable income will be generated to realize our deferred tax assets. It is more likely than not that our deferred tax assets will not be realized, meaning they're not going to generate profits in the future to use as deferred tax asset. So they just have to get rid of it at this point. Therefore, after consideration of our deferred tax liabilities and recent developments, we provided a valuation allowance of $295 million. That determination was also based in part on our expectation that our projections of pre-tax losses in 2024 and future years will cause us to be in a cumulative GAAP loss in 2024 and going forward. So even a company knows they're not going to be generating profits probably ever again. Here's their EPS calculation. 155 million shares outstanding last year, but it's down to 151 million. That's a surprise. I thought it would be up. Let's see how much cash they have left to remain a going concern. So 134 million of cash. Let's see, 369 million of current assets, 219 million of current liabilities. So they have a good current ratio. So let's take the cash. They also have 92 million of debt, but that debt is probably not due for a few years. Let's just ignore it for now. So they had negative 98 million of operating cash flow in the first quarter. So let's use that number. So they have less than 2 quarters of cash remaining. So they're going to need to raise more debt or dilute shareholders. And their market cap is 200-something million. So their cash is less than their market cap. Someone wrote a comment on one of my videos saying they were trading below cash value. He was probably looking at their cash at the end of 2023, 222 million. And yeah, their market cap is 213 million. So they are trading below cash value at the end of 2023. They are not right now. But there's so many other things to look at, because accounts receivables is cash they're going to receive within the next 12 months. They also have inventory they could sell. They can't really sell this stuff. Goodwill is meaningless. You could sell property and equipment, but it takes a while and you need that to run your business. But there's also expenses. They have 64 million of accounts payable, so that's a wash right there. Another 89 million of accrued expenses. Let's see what that is. Accrued sales expenses. So these are probably bonuses for their sales team. More employee liabilities, 10 million. Accrued liabilities, 19.8 million. Not really sure what that is. I know what an accrued liability is, but I don't know which liability this is for. So they're not really in good shape. They're definitely going to need a lot more debt. They should try to raise more capital, but their access to the capital markets is tightening because their market cap is going down. So it's harder to raise capital with a lower market cap. You have to dilute more shareholders. And you could take on debt, but you pay a high interest rate because they're high credit risk. Let's take a look at a statement of cash flows. A cash burn of 100 million in the first quarter. Last year was 67 million. They spent 12 million of acquisitions. Let's see what that's for. A few months ago, they acquired Foresight Helmet Systems. That company offers technology-enabled helmets, and they paid $14 million. This is what they received for the 14 million. 7.5 million in developed technology. The rest is goodwill, 5.9 million of goodwill. Let's take a look at their financing section. They raised 1.4 million from issuing stock. They paid 2 million in taxes from giving equity to their employees. Let's look at their PowerPoint slides. Here's some data from the last 9 quarters. Revenue peaked in Q4 2022 at 320 million. And it's been downhill since then. Every quarter is worse than the last. Not the last quarter in the prior year. You can see Q1 2023 is lower than Q1 2022. Same thing for Q2 2023, Q3 2023, Q4 is down, and Q1 2024. So Q1 2022 was 217 million, then 175 million, now it's 156 million. Camera units shipped. They shipped a lot in Q4 2023, even more in Q3 2023. 900,000 units shipped. So they're shipping more, but people are buying the less expensive cameras. They shipped a lot less in Q1 2024 compared to Q1 2023. Margins were over 40% in Q1 2022, down to 30% in Q1 2023, but up to 34% in Q1 2024. And they're adding employees, which is surprising. They're up to 937. They should be really cutting employees since their revenue is going down. GoPro.com revenue was 54%, now it's down to 32%. That's the best revenue because it's recurring and it's higher margin than selling cameras. But their camera revenue is 68%. It was 79% in Q3 2023. Hardware revenue 76%. Now it's down to 47%. So subscriptions are going up. It's going up as a percent of revenue, but it's only up about 3 million from 23 million to 26 million. They did have a lot of cash, 449 million. They're down to 134 million. Products are in storage 116 days before being sold. So it's getting worse. It was only 49 days last quarter. So you want to lower this number so inventory is not just sitting there. It needs to be a balance. You don't want it to be too low and run out of inventory. It takes 40 days for them to receive payment for a sale. That's getting worse too. You want this to go down as well, not go up. But it's a balance also. You don't want this to be too low, because if it's too low, then your credit is so strict, people don't want to buy from you. Subscribers is a really important stat, but that's plateauing. It actually went down for the first time. 2.5 million subscribers. It had a nice steady growth. Maybe if they sell more lower cost units, this number will finally go back up again. The revenue from this is 25.4 million. So each subscriber spends about 10 bucks. Their EBITDA is negative 30 million. It was positive the prior 2 quarters. They did have a big negative in Q1 and Q2 2023. That big net loss this quarter is due to the deferred tax asset, so you have to add that back. That's a non-cash item. But even if you add that back, they still have a big negative. Let's look at the stock on Simply Wall Street. Its last price, $1.40, 213 million market cap. It is up 7% in the past week, down 66% in the past year. It started trading in 2014, almost exactly 10 years ago. It started out in the mid-30s, and in 3 months, it hit its peak 94. That was October 2014. 5 months later, it was down to its IPO price of 40. Then people thought it was a good buying opportunity. It went from 40 to 65. That was over a 5-month span. And then it's just been downhill since then. It went from 65, 1 year later, 13. And it got real low at some points. $4 in 2018, $2 in 2020. That was the COVID low, $2. Then it ran up to 14 in March 2021. Hopefully you didn't buy then, because it's really struggled since that point. There were some upticks here and there, but if you held for more than a couple of months, you probably lost money. Simply Wall Street does not value this company. 2 analysts priced this stock at $1.85. The revenue forecast for this year is $919 million. Next year, $977 million. That's surprising. They expect it to go up. And then after that, still $977 million. But their free cash flow forecast this year is negative $40 million. No forecast after that. When a company IPOs, they get a bunch of cash and they usually pay down debt. That's what they did. They had no debt in 2015, 16, and 17. Then they added some debt in mid-2017, $125 million. Their debt peaked at $265 million in March 2022. But they've been paying it down. It's down to $92 million. And their equity is usually higher than their debt. But a lot of their equity is goodwill. And this green line is their cash. They do have more cash than debt, but they're burning so much cash each quarter. The CEO's salary in 2017, $800K, $1 in 2018, $800K in 2019, $240K in 2020, then $850K in 2021, 2022, and 2023. Total compensation, $6 million, tenure as CEO, 20 years. Half the company is owned by institutions, 31% by the general public, and 18% by insiders. The CEO is the biggest shareholder. He owns 17% of the company, then BlackRock, Vanguard, and a lot of funds own this stock as well. Their employee count was 646 in 2013, up to 1,500 in 2015. Now it's at 930. And the ticker trades on the Deutsche Börse, Nasdaq, Xetra, Mexican Bolsa, Swiss, London Stock Exchange, Wiener Börse, EuroTLX, and Sao Paulo Bolsa. Let's learn about the history of the company. They were founded by Nick Woodman in 2002. I remember he was on an episode of Shark Tank. What motivated him to start the company was in 2002 on a surfing trip in Australia. He wanted to get high quality action photos. He got the name GoPro because him and his friends wanted to be professional surfers, and going pro was the ultimate goal. He raised capital by selling bead and shell belts for under $20 from his VW van, and later he sold fashionable camera straps. He also received $230,000 from his parents. In 2004, he sold its first camera system, which used 35mm film. In 2014, he hired former Microsoft executive Tony Bates as president. In 2016, GoPro partnered with Periscope for live streaming. He grew the company to 500 employees by 2015, but the company had weak sales, so we cut 100 workers. And then at the end of 2016, he laid off 200 more employees to reduce costs. Also, President Tony Bates was stepping down. In 2011, GoPro acquired Cineform. Cineform used their technology in movies like Slumdog Millionaire and Need for Speed. GoPro incorporated Cineform's technology into their 3D Hero system. The Hero brand was their most popular camera at the time. In 2015, GoPro acquired Color. That's spelled K-O-L-O-R. Color is a media and virtual reality startup based in France. In 2016, GoPro spent $105 million and acquired two startups, Stoopflix and Vemory. They acquired those companies for their video editing tools, Replay and Splice. In March 2020, GoPro acquired the stabilization software company RealSteady. In May 2014, the company filed its Form S-1. The Form S-1 is a document the SEC requires for a company to go public. When they filed the S-1, the company stated they hoped to raise $100 million through the sale of shares, and they would use the money to pay off debt. They had $111 million of debt as of March 31st, 2014. We saw on Simply Wall Street, they paid off all their debt after they went public in 2014. They also wanted to use some of the money to acquire or invest in businesses, technologies, or assets. They sold 17.8 million shares for $24 each, totaling $427 million. Right when they IPO, they were valued at almost $3 billion. Another reason GoPro decided to go public was they wanted to be a media company. They wanted to generate revenue from the content its cameras create. Obviously, that never happened. Nick Woodman worked on his first camera for 2 years after he found the company. The name of that first camera was the GoPro 35mm Hero. In September 2004, he showed that camera at San Diego's Action Sports Retailer Show. In his first year, he had $150,000 worth of sales. In 2006, the company introduced its first digital hero with 10-second video capability, which generated $800,000 in revenue. The next year, sales quadrupled to $3.4 million. In 2018, the company said they sold 30 million Hero cameras since inception. 30 million cameras since the movie Inception came out. The GoPro Karma was GoPro's consumer drone until its discontinuation in January 2018. In November 2017, the company launched the Fusion camera, an omnidirectional camera which is capable of recording 360-degree footage. They sell a lot of mounting accessories, including a 3-way mount, suction cup, chest harness, Jaws-type flexible clamp, dog harness, surfing mount, etc. They developed GoPro Studio, a simple video editing software to edit camera footage. They announced they wanted to be a content provider. especially once they came out with their new app for the Hero 5 called GoPro Quick. That made editing a lot easier and faster. In 2020, GoPro canceled their GoPro Quick software. But earlier this year, a new version of the Quick app was released for Mac OS, with a version for Windows coming later in the year. In 2014, GoPro was listed by Adweek as one of the top 10 best brand channels on YouTube. That was based on views, shares, comments, and overall engagement. As part of their media expansion, they added channels with GoPro content on YouTube, Virgin America, Xbox Live, and also PlayStation Network. So that's the end of the video. Let me know what you think. Thanks for watching.